Good afternoon. My name is Scott Redler, Chief Strategic Officer of T3Live.com. I want to welcome everyone to a special edition. Here at T3 Live, we like to bring in very well-respected people in the industry into our studio to give another perspective on what they're seeing in the market. So sometimes our perspectives align, sometimes we're seeing different things. It gives you guys a different look on how a lot of different technicians approach the market. So today I'm here with Greg Harmon, a very well-respected technician, CMT, CFA, the president and founder of DragonFly. And at this point, I want to say thank you for coming to the office.
Thanks for having me, Scott.
You came all the way from, where are you located at now?
Just outside of Cleveland, Ohio, Shaker Heights.
Okay, well, he's here in Manhattan. We have the luxury of having him here in our studio. And those of you that know me out there, you know that I call myself like a cotton napkin technician. And at this point, I want to know a little bit about Greg's process. You know, you've been doing this a long time, since 1985, and how would you describe yourself?
Well, I'm a top-down technician. When I take a look at the trend in the SPY, the S&P 500, IWMs, Qs, and then look to see what kind of stocks are going to be set up to move with the trend. I do also do a little intermarket analysis to look at things like gold and oil, the dollar, some foreign markets that might impact where the S&P is going to go.
So all kind of indicators to give you clues, because as technicians, we don't look really at news sources. We look at what other sectors are doing to give us indications of what's going to happen.
Exactly. I mean, you read the paper, you see the news, but you try to do your best to ignore it all. And so when I've got then the trend in my mind, I'm then just browsing through. I've got a universe of 1,000 stocks. I look through those one by one, no scanning, every weekend to cull down to a list of about 50, 60 names that look pretty good to me, and then 10 that I will be focusing on for the week to start with.
So that sounds a little bit like our formula here too, because what we have is a price point sheet, and we call it our go-to list. It's usually about 25, 30 stocks that we iron down or kind of like go from the universe into a smaller universe, because as technicians, we can't look at 1,000 stocks. We only have so much landscape on our monitors, so we want to look at the ones that are set up. And for me, I call it like my A, B, and C list. Mm-hmm. And I know for you've been talking the last 5 months about doing trends, and it's been a bullish trend. And recently, with the action, are you still as bullish, or are you a little bit more cautious?
You're starting to see some signs of caution in the marketplace. Some divergences, looking at the RSI or the MACD. Some things are starting to roll over a little bit, mainly on the daily charts. The weekly charts, most of them still look pretty solid.
Right. I would say, this morning we talked about the different trends, and in yesterday's action in the S&P, we talked about the accelerated trend that was broken yesterday. Okay, not the macro trend, not the intermediate trend. I'm going to put up the chart so I could hear Greg's take on it also. If you look here, from what I see is a very healthy trend. Okay, started back here in November. It actually started way back when, which we can get into. And this is your gradual trend. Here's your intermediate trend, and then right here is what happened yesterday in the S&P. This is when we broke the 8-day moving average and close below it. And right now, I'd say short term, what would you think is important in this upper range to look at to see whether or not we continue to test the intermediate trend or go lower?
I've been looking at the 153.25 level, below 155. 155 seems to have been pretty solid. 153.25, 153 would close that gap.
So you're saying so this would be your intermediate line in the sand?
Yeah.
Okay. So if you're very, very active, like a lot of guys in our trading floor are, I would say a lot of people probably took off some positions yesterday. Mm. If you're maybe not as active and you're trying to wait and see, so you're saying this would be your zone that if we close below, you could see a little bit more downside action?
Yeah, and I'm not a day trader. I'm more of a swing trader, so that for me, I can give it a little more room on that.
Right.
I'm looking for a longer-term risk-reward on the trade.
Okay, so if I'll go to longer-term charts. We'll take a quick look here. Get you a little bit more of a snapshot look, because you'll see that there are people that can't be in front of the computer every day, and this trend that comes all the way back here doesn't even come into jeopardy until about what, 145?
I think it's like 142, but
yeah, that's exactly what it is. Right here around 142 into this gap below the 200-day.
Yeah.
So at that, so you're saying at that point you would become less bullish, or you would be looking to buy that?
Actually, above that, more around the 150, 148 level, I'd start to get nervous.
Nervous.
I would have lightened up before we hit, or soon after we break 150, and if we get down to the 142 level, I'd start looking for long-term shorts as opposed to looking for dip buys.
Got you. So right now, on an intermediate basis or very short term, you're looking at this 153, okay, and then a little bit more intermediate, where more macro guys might get a little concerned, would be around this 150.
About 150, yeah.
And then long-term guys better step in right around here, and I think that that's one of the bigger macro with all the big bears out there. I think you said you're going to see Prechter today.
Yeah.
So I'm sure he would like to see that thing get broken or tested.
I'm sure he would. I'll have to get back to you on that after I hear him.
Well, at this point, I feel like you've been bullish, and you said, I think in the long term, you're looking at S&P.
Well, I've got one. I don't use Elliott Wave much, but for the S&P 500, I have been able to find a starting point, and surprisingly, I disagree with the work that Mr. Prechter's done, and
no, that's
I
good.
see a long-term target on the S&P that could possibly go as high as 1900, 1925, somewhere in the 2014, 2015 timeframe. 2000,
really?
Yeah.
Okay, that's high, because I know for some of the work that I put out there in the last year, we've talked about S&P, 1700, and I said by 2015. So that's pretty.
Yeah,
that's a high target.
Well, it's less of a target for me than let's say call it a bound.
Right. A
directional bound. So for me, using the Elliott Wave, it's more like, well, that's another indicator that says the trend is up, it's going to go up. Right. And we talk often, I use a whole lot of different charting styles, but when they all line up, right, it gives you a lot more confidence that the trend is going to be the way it has been going for a while.
Okay, so it's good to hear that someone else out there is bullish on higher prices, that this isn't going to be a triple top or a breakout failure. But at this point, we never know. I talk about different time frames. I talk about everyone can approach the market different ways. I know my wife has a 401k and she's doing okay. And, Prechter would probably say, sell everything, And for me, I think that, if you would have sold everything 3 different times during the course of this decade, you still wouldn't have done well.
Exactly.
Right? We had the internet bubble, we had 9/11, and we had the financial crisis. Yep. And then here we are with Dow all-time highs and S&P all-time highs. Yep. So I personally think that the market longer term could work for you with a plan, monthly funds, okay, into an S&P 500 fund, if you don't time it and you continue to do it. But I think our sweet spot, including mine, is that intermediate time frame. I talk about portfolio approach and tactical approach, meaning when the market's following its 8 and 21-day moving average, it kind of makes it easy to hold multiple positions because you're never really getting tested. And then when we break that, I go from maybe 8 to 15 positions down to 3 or 4, and then I look for longs and shorts, which I think in this little spot is where I'm at. I'm trying to be a little more cautious because I don't know if this shorter term trend is broken.
Yeah, well, for me, it's a little bit different. I'm still looking at going through the same process, getting down to 10 names that I'm focusing on with another 20 or 30 behind them. But for me, feeling that the sentiment is starting to change a little bit with the divergences starting to show up in the MACD and the RSI, overbought signals here. I will lighten the position size, but I'll still
stay with some.
I'll still stay with a sizable number of positions if the breakouts are happening.
But you'll just use like a tier system where you won't be in tier 3, which could be your biggest core position, and you might be in tier 1 to stay with the trade and then re-enter more if it shows you something down the road?
It'd be more that I would just determine that I'm going to do a half size or a third size.
It's the same thing, but a different language.
Yeah, same thing, different language, but I generally won't add to it.
Right. And I want to hear that language because we were talking about it before. I want to see your take on some of the sectors that gave us some clues earlier in the week that showed some engulfing bars that gave us some clues that maybe we would see some corrective type activity. And let's go to the Russell first. I mean, not the Russell first, let's go to the transports first. Now, I showed you this chart before, and this is on what's it called, Monday. This gave me a little bit of some clues that this engulfing bar that took out Thursday's low was that we could see some weakness elsewhere. Now, at this particular point, what are you seeing with this chart?
Well, there's a few things I see there. There's the 3 red candles coming down there. 3 black crows is what we call it with a Japanese candlestick terminology.
3 black crows.
Which would indicate more downside to come. But you could also take your trend line that you drew there from March 4th, the top one, and flatten that out a bit and get a head and shoulders top there, a bit higher up, starting I think March 4th.
Well, if you look up here, this was somewhat of an active one. This was here, your left shoulder, right? Your head, your right shoulder. But and we got down to here. So sometimes what the pattern measures distance, and from the head to the neckline is right there. So some would say that on a short-term level,
take us down to about 104.
Yeah, it takes you right around there, give or take. So it could be, I guess, down to 104 also. And then I guess, the macro guys that are trying to be really visionaries, they might say that, we're going to come down to here and then bounce up to here, create this, and then
a big old head and shoulders.
A big old head and shoulders. But obviously, this is like you're painting a picture that you want to see versus
exactly.
what's happening right now.
Yeah, so you got to play with what they give you.
Right, at this point, my rule is on 3 down days, you kind of cover no matter what, and then trying to figure out what could be next. So I guess if we hang out here and there's no bounce, then that would say there's no buyers in these cheaper levels, and then we continue down to meet that overall measured move.
Yeah, when it starts falling down and then starts to consolidate, it's shifted the short-term trend to being a downtrend, and that consolidation then in my mind becomes a bear flag.
Right. So
and until it starts bouncing back up, it's a bear flag, and it's going lower until it proves that it doesn't want to go lower anymore.
So would you say this would be something that could be drawn? Here's your pole, here's your flag. So if it were to stay below this 108.85, that would give you some confidence that it can continue down to perhaps this area?
Absolutely, yeah.
Okay, and if we look real quickly at the IWM, pretty similar. This one's acting a little bit better today, but look at this trend line that was broken. Now, is this the same type of 3 broken crows? What's it called?
3 black crows.
Black crows. Yeah. in a broken trend.
Same kind of thing. What's I think very interesting with this one as well is that that third one closed the gap.
Oh yes, from right over here.
Yeah.
So that means it took away some of that power.
You would expect some of the sellers to lighten up, closing that gap.
Why do you think that is? I love trading gaps. We talk about gaps all the time in the technical world. We talk about pro gaps that ignite moves. And we talk about gap opens that could be traded for cash flow. What's your theory on gaps? How do you like to maneuver them or use them as a vehicle for direction?
Well, I look at gaps in a gap like this on the IWM and say that once it starts coming down, they often turn into magnets.
Yes, and they turn. And if they protect the gap, right, that would mean that it's a little bit more bullish. But if they fill the gap, that means they didn't have enough power to protect it, and it could be lower prices. Now, I want to show you a gap in Nike. So, for instance, Nike, I like to look at earnings gaps, and this stock had a really nice gap up, and then it's been consolidating. To me, this looks very bullish because the bears haven't been able to push it into the gap, so they're trapped, and people are paying higher prices. What would your thoughts be on Nike potentially, with this gap right here, or do you not look at Nike?
No, I actually wrote about Nike last night. Nike and Under Armour as 2 trades to get into, and
good.
Scott knows. I don't know if the rest of you know or not, but I trade a lot of options, and I looked at this as
so what was your
one with a marketplace where we may have a correction. The initial move to get into Nike might be to sell downside puts in the 54 range.
So you would say
55 range.
Okay, so that makes sense. So you would sell these puts, and you would say that that's better than
which says the same thing that you do. That I like this going higher, but I don't want to go full force. I want to limit my risk. I want to limit the amount of capital I put into it, but still have some upside exposure. So I might, in addition to selling the downside puts, I might buy. I might sell downside puts in May and buy upside calls for April in case it does break out.
Would you do a potential call spread? I feel like I've been having some success with call spreads lately because of before when there was a lot of premium in some of the high flyers. You limit your upside, but at least you finance it. And
I like to do those more when there's defined upside resistance.
Right.
With Nike, that doesn't exist right now. And I also like to do it when the market's trending more.
Right. And right now, I think options are good because at least your risk is premium paid versus if it all of a sudden starts to really fail. And so
right. And then in the trade that I put out last night, I think it was selling the May 55 puts and buying the April 62.5 calls. You could actually put that trade on for a credit.
Okay, sounds
good. So if it stays still, you're still good.
And what about Under Armour? You said you liked that one also?
Yeah, Under Armour, I did like that last night. It's starting to look like a bit of a topping candle there. What you call either a doji, a lot of people know as a doji. I'd call it a spinning top as well.
You would call this a spinning top?
Well, not now, but
Looks a little bit like a doji, as if it's just kind of consolidated, broke out right here. It's in the middle. Well, by the way, we're talking, just for full disclosure, what time is it right now? It's like 2 o'clock and the market's open, so these things are moving. It is Thursday. We'll try and get this out as quick as possible to you guys. But basically, I like the way Under Armour looks too. It's above all the moving averages. It broke above this area. I wouldn't say this just shows me that it's not ready to continue. That now It's in the top end of this wide range bar. If we were to stay in this top end and go sideways, and the market doesn't fall apart, it would seem like there'd be a continuation move above, this recent little 2-day pivot.
Yeah, it's got a nice rounding bottom that it's turning out of from early December up through to now, and it's just starting to hit the upside on that. So you'd look for it to go to at least 55, 56 before it eventually stops.
And would you come up
with that because of this? Yeah, just to retest that November high. If it gets through that, sure, look for the next one at 60.
Yeah, 60 comes all the way up here, your next point of reference. We were talking Facebook before. Facebook is having their big day, their phone or whatnot. I've talked about this in 2013 thesis. It was like right around here, and I was saying it can get back to 32, 33, just because that was your old point of reference, and it happened pretty quick. And since then, it's been pretty much in a down trend where I've tried it a few times and it's lost. I'm long a little bit of it now. What would you say, if you were just to give you a quick and dirty on it right around here?
Well, you've got a nice descending wedge on that, and breaking out above that descending wedge, which would be a very bullish sign. You look at the move there, it's about from 28 to 32 at the top. So you look from a pure technical standpoint, I look for a $4 move off of 26 up to about 30. And you can see that there's some potential for resistance there around 29. But if you back up a little bit on that chart,
okay, that's probably like here you have the moving average and then you have these points of reference. So if it wants to close above this, potentially it can continue. We'll see what the analysts say tomorrow about it. But okay, so let's go a little bit backwards.
You back it up on this, there's actually a harmonic that's going on in this as well, starting with the high in late June down to the low in late August.
The high in late June, which is right here. Right?
Yep.
Okay, then the low in late August. Okay.
Back up to the high in September.
Okay.
And down to the low in November.
There you go.
And without my calculator, I can't tell you what the projection would be there, but it looks as though it went through about 100% move back up after that, and then a 50% retrace.
What we could do? We could probably go into one of my little retracement area here, if I could see it on my little toolbox. Let's see real quickly. I'm not sure if I have it right around here. Let's go to Tools. Okay, we'll do it after. But you could draw so you're basically saying from here to here, it's retraced a certain amount, but not too much to negate the power of this first move. So this is about a 50% retracement.
The harmonic would be that June through to the high in January, suggesting a pullback, but then the pullback met its initiative down about 50% around that 25 area. So it's a good spot from a harmonic perspective for it to reverse and start going back higher as well.
Okay, well, it seems like so far it started. Now, for me, I would say I would like to see this thing show some commitment, which is what I say, to a potential descending trendline break. So I'd want to see this at least hold here, go sideways before attempting. If it were to break out and come below, kind of like what we saw Apple do a few weeks back, then it would negate this potential bounce. You had this bounce a few times, right? Bounce down, bounce down, bounce. Will we see commitment? So I think as long as it stays above this 26 and change area, perhaps we get this next, initiative.
Yeah, but in terms of that, if you look at that chart again, it's also kind of like the coal names and the steel names.
Right.
Bounce down, bounce down, bounce down, and
it
could be that too, right?
Right. Well, at least this is an IPO and doesn't have as many memories besides the horrendous new issue. As far as some of the charts you sent out last night, are there any ones you want to go over that you think could be, profitable trades in the coming days that you want to introduce to the community?
What I noticed looking at the macro level last night between the SPY, the IWMs, and the Qs, the IWMs have been going up for a while for leading on the way up, and the SPY were lagging a bit, and the Qs just stayed steady.
Right. Do you think that's because of the weighting in Apple? Because the Qs have underweighted this entire rally.
It could be. It could be, yeah. But looking at without the components, without any kind of look at the components in them, what I've been looking for and playing for is a rotation out of IWM and into the Qs.
Okay, so you're looking for the Qs potentially
so
to
almost
be
like a regression,
okay.
a regress to the mean backwards, that the Qs now take over and lead for a while.
Okay, let's take a look at the Qs. Let's see what's going on here, because I think traders would love that. One of the problems traders have all been having is that the high beta tech's been lethargic, the technology's been lethargic. Like if you look here, you look at the September highs here, where every other industry took it out. This has done nothing. Okay, and at this particular point, from the start of even the what was this, January, it's really just been a very lethargic move. It is in a trend. You could say, it's in a decent trend. So what would give you some kind of confirmation that money comes here, out of just say the Russell, the transports, and some of the others?
It's had a real sticking point at the 69 level, and a close over and hold over, especially on a weekly basis, over like 69.30, 69.40 would give me a whole lot more comfort. If you could pull it back to a weekly chart.
Okay, let's go to the weekly.
You can see there from that April 2012 through to now,
right.
It's essentially been one big consolidation area. Could also be another harmonic pattern, but
right.
It's been in a clear uptrend from November, a little more clear and a little stronger at this point than what's been happening with the IWM.
Right. The IWM, if you go to the weekly chart, you'll see, this has been a very strong trend. And actually, if you look at the weekly chart, if this were to close right here, that would be pretty bearish short term, because we'll have engulfed this upper range, close below the 8-day, and taken out this entire time period. So I think, for me, looking at that on a weekly basis, then it tells me that this should get at least down to what, 89.20?
Yeah, somewhere in that area.
And then this prior breakout comes in right around here. So it seems to me that there are some signals now saying to be cautious, that we are in a strong trend,
Definitely.
a trend that could be over a long extended period of time. But if you approach the market actively, like a lot of my guys do, or in our community, it'd be more prudent to look for some shorts maybe, because if these things...
I think if you're a day trader trading, if you're flat at the end of every day, then you should be looking for setups on the short side.
More short side than long side?
More short side than long side.
And within the last 3 months, it's been more long than short side?
It's been long all the way. And I think even if you're a swing trader, you should still be leaning towards the long side.
Right. So it's multiple time frames. And one of the things we always talk about is you have to know your time frame. Because you could be a swing trader or a macro investor and say, oh, I'm going to get out now. And then all of a sudden you do get a minor pullback, and then you're away on vacation, or you're not in front of your keyboard, or you're not getting back involved. And then, in 2 months from now, market's at highs again, and you felt like you saved some money by being cute, but that wasn't your time frame because you wanted to own it later. Like, just say Bank of America, for instance. I just want to give that example. For me, I truly think Bank of America later this year could be a $15 to $16 stock. But if you look at it now, a lot of people have been saying to me on Bank of America, like, come on, Red Dog, you see the weakness in it? You see the breakout failure up here? I'm like, yeah, I do see that, but do you see the move that it's had that started from $8? Okay, this was when we did a call spread on Bloomberg. Here's when every technician in the world was looking at $9.95. Remember that?
Exactly, yeah.
And then you had a quick move, and a lot of guys got out right here when this accelerated trend broke to the downside, and they felt good as it came into this area. But then once we were at highs, they were scratching their heads like, oh, I felt good because I saved myself 70 cents here, but I'm not in for that. So the question mark is, if you're in it for the long term, like, what would you think? Have you looked at Bank of America? Do you think, a year, 2 years out, what would you have a projection on Bank of America?
Just looking at what you have up here, I don't know that I have a projection on it, but it certainly looks as though that consolidation around the 9 level and then up to the 12 level has a move to 15 in it, at least in the next 4 or 5 months.
So if you look at the weekly chart, that's what I was looking at too. It's like, the next spot would be this 200-day coming in here. So at this point, so for your technique, you would be, if you were in it for a macro position, you'd just be a little less until it either comes down a little bit, or you said if it gets above, what, 1250?
Yeah, 1250, start getting interested in new highs, you could go all in.
Okay, so I hear you. So it's just really important to know your time frame.
Exactly.
And know where you want to live, know what your risk tolerance is, and know your commitment to it. Because a lot of people think they have all this time commitment to the market, and then they don't.
Exactly.
And a lot of people think they could trade multiple positions. They think they could have bigger size than they could take advantage of or handle, and then all of a sudden they have an idea and it goes against them. They get a little worried and they get out of it, and then it goes up a few days later. So it's just, for our community, we try and talk about the formula to approaching the market, because the technicals are great. How many times do you have technicians that talk about the same thing, and then traders look at the chart and one makes money and one loses money? And what would you say that fine line is for people?
Yeah, I think that you've hit on it. The realization is that you need to understand how to create the right position size, how to manage your risk. You can't just have a 20% stop on every trade or a 5% stop on every trade. You need to have a real reason for the stop in place. For Bank of America here, we talked around 11.50, and if you're a longer term trader, more like around 11 as your stop.
Right. I feel like a lot of traders, unfortunately, they put a stop in based on what they think they could lose instead of whether or not the trade changes. So it's not really what you think you could lose. It's more like, okay, is my idea wrong because this happened, versus, okay, I lost this amount in a day, I only want to give myself that much, which is good because that's good money management.
Yeah.
But if you're a swing trader and you're in it for a reason, only use the stop if that reason changes.
Exactly. If the setup changes, then it's time to get out. If the setup hasn't changed, you've set your stop so that it can go against you, but you're still like the trade.
Exactly. All right, well, listen, I appreciate you coming in. I hope you have a great time at
Thanks,
the
sir.
conference you're going to, and I'll see you again soon in the future.
That sounds great, Scott. Thanks for having me.
My pleasure.